We're going to do a review of 7 stocks to buy now for 100% returns in 2025 by Joseph Hogue, CFA. And let's get started.
Joseph Hogue here, and what a year it was. 7 stocks in my portfolio returned 100% last year alone, and I found 7 more to buy now that could double in 2025. I'll reveal those 7 stocks to buy now for 100% returns in 2025, along with what we're looking for in these kinds of triple-digit returns. But first, it helps to know what went right in last year's stocks, how 8 stocks alone returned a profit over $510,000, and what it can tell us about investing this year. You see the 8 best performers here in my trading account, from 171% return on shares of Palantir to 94% on Shopify. And if we break these down into groups or themes, we see 4 ideas that can guide your investing for 2025. These 4 themes are, of course, 1, artificial intelligence with Palantir, SoundHound AI, Innodata, and Duos Technologies.
I've actually never heard of DUOT. I've never heard of SOUN or INOD. That's great because a lot of times creators will rehash what other creators are saying, but these are unique securities that I'm not familiar with.
On the AI, Innodata, and Duos Technologies. AI was the theme last year, and we're just now starting to see the returns flow down to those use cases and the companies leveraging that technology. FinTech also had a very strong year with SoFi Technologies and PayPal on my list. Let's get started with our first stock to buy, Symbiotic, ticker SYM. But stick around and I'll show you exactly what I'm looking for in these 100% plus stocks.
All right, let's check out SYM. I'm not familiar with it. SYM has a market cap of about $16 billion. It has negative net income. It's trading near its 52-week high. It was down almost 40% over the past year, but 5 years it's done pretty well. Financials. Let's look at the balance sheet. It has a decent amount of net cash, so it doesn't have to worry about debt. Its revenue growth is solid. However, it's slowing down. Yeah, overall, I wouldn't touch this stock. I'd be concerned about its financials. One thing I really don't like is its gross margins. It's making $280 million off revenue of $1.8 billion. It's very low. So I'm not a fan of this company.
Stock I'm watching here.
Or Enphase. Enphase has a market cap of almost $10 billion. It's trading way off its 52-week high. Over the past year, it's down 38%. It's done well over the past 5 years. It has decreasing revenue growth. It looks like revenue has fallen off a cliff. Its margins are decent. They're not incredibly high. Its net income is falling. It has bought back some shares, which is good. Let's look at the balance sheet real quick. So it does have a net cash position, which is great. So you don't have to worry about debt. But overall, based upon its performance, I definitely wouldn't touch this company. Let's check out the third company.
At the price they were low. We're seeing the pullback.
SMCI. Let's check that out. SMCI market cap of about $21 billion. It's trading at its 52-week high. Its PE ratio, which I'm not necessarily a fan of, is reasonable. It has very strong revenue growth. Its gross margins are low, so that's a red flag for me. Looking at the balance sheet, it has about $500 million of debt, which is a decent amount. If you look at the cash flow statement, it has negative operating cash flow. I like this company more than the other ones. I think that if they're able to increase their margins, then I would like it more. But considering that last year in March, it was trading at about $120, I would pass on this. Although I do like this company more than SYM and probably more than Enphase. Let's check out the fourth company.
Pullback in shares.
IIPR. I like that he's giving me new stocks that I haven't heard of before. Let's check this out. IIPR. Over the past year, it's down around 30%. It's a very small company with a market cap of about $2 billion. It does have a low PE ratio and it makes money. Financials, it has a low amount of revenue growth. It has very high operating margins, which is good. Let's check out the debt. So it has about $300 million in debt and its cash and cash equivalents is about $150 million, which is not bad. I'm a little bit concerned that it's fallen from 135 down to 67. I would want to know why it's been cut in half, but overall, it seems like a decent value play. Let's check out the next stock.
Back to our list though, and UiPath, ticker PATH.
All right, let's check that out. UiPath, it's down around 40% over the past year. although it looks like it's stabilized since June. $8 billion in market cap. It's losing money. Over 5 years, it's down 75%. It has decent revenue growth at 16.5%. Let's check out its debt. It has a large cash position, which is great. Let's see if it's diluting shares. Shares outstanding. Yeah, so they're diluting shares. I think this is an okay company. I like that it's stable since June and that it hasn't fallen. Not my favorite company, but it's better than some of the other companies on this list. Let's check out the next one.
Is another AI stock I've been buying. Pharmaceuticals ticker.
So the next one is Recursion, RXRX. Let's check that out. So a small company, about $2 billion in market cap, negative net income. So anytime it has that, I want to look at the debt structure. Let's check that out real quick. It does have a positive net cash balance. It has growing revenues, but its gross margins are horrible. It's definitely a red flag. Over the past year, it's down 33%. Over the past 5 years, it's down 56%. I'm always wary about pharmaceutical companies. And you have the new incoming administration, which I believe is going to change some of the laws. So this would be a hard pass for me. And the final stock.
Next, about the only AI stock breakout surprise.
The final stock is Rivian, RIVN. Has a market cap of $16 billion. It's losing money. Decent revenue growth though, 20%. But its gross margins are very bad. Shares outstanding, you can see that it's been diluting tremendously. Let's check out the debt. It does have a large cash balance, but you can see that it's been eating through that cash balance. Previously, it had almost $10 billion of net cash. Now it only has about $700 million. I also think that Rivian is not going to be able to compete with Tesla when you throw in the tens of billions of dollars of free media coverage and marketing that Tesla enjoys, and that Tesla is going to get favorable legislation in the incoming administration. I don't think it's going to be able to compete. So those are my thoughts on the 7 must-buy stocks to buy now for 100% returns in 2025. To be honest, I'm not a fan of any of them. That doesn't mean that I know any better than Joseph Hogue. I just think that there are safer opportunities. Almost all of these stocks have underperformed. And while I do appreciate that many of these are deep value plays, I would ask myself why these stocks are deep value plays and why many of them have gone down during a bull market. So I probably wouldn't buy any of them. But that's just my opinion. Let me know your thoughts. And if you like this video, click on the video that's popping up on your screen now because YouTube believes that you would enjoy it the most.